So this is our last lecture today. I asked the day before the day before yesterday. I asked again at the about the exam, and they said to me it will probably be an oral exam because of COVID, the COVID situation. So it's only suitable to organize an oral exam. That's the most likely option. And you will be informed about the date and the procedure, of course. It will be in the coming weeks. In the coming weeks. I don't know exactly the date. They probably also don't know exactly the date yet, but they will inform you. Do you have any questions related to that?
No.
No. Okay. So I'm sorry that I cannot tell you more specific things, but this is what they told me. So I can only tell you what I've been told, and so we will see. They will inform me, and they will inform you, and then we will organize it. So yeah, that's it. Yesterday we, as you remember, we repeated the analysis about Apple. We looked at the Apple statement, and then we looked at a new company, which is Starbucks, and so let's have a second look at the company, or the number as I calculated. So you can also see the screen now, and I sent you the statements. So what if you look at the company's numbers, what do you see? We said it's a good company, but maybe can you tell me a little bit more specifically what happened over the last couple of years? What about the performance of the company? What about the financial position of the company? Dividend policy, and so on. But maybe let's start with the performance, and please use your microphone, yeah, as you did in the last lectures. This is good, and please today as well use your microphone when you answer my questions. That would be very kind of you. So what about the sales? Okay, the sales went up over the past couple of years. What about the growth rates? If you look at the growth rate, is this a fast growing company, or what do you think? Okay. Okay, it's good for a big company, and it also seems to be quite steady. Yeah, there is 2 years actually, 2017 and 2019, where it's only single-digit growth. In all the other years, we have double-digit growth. But there's no year actually when sales went down up until 2019. What about the net income? If you look at the net income, what about the performance there and the development? Exactly, yeah. So we have 14.6% average growth rate, which is very good. So we have some what is called operating leverage. This is when net income growth faster than revenues, than sales, and this is because we have certain fixed costs. Yeah, when we have certain fixed costs and revenues grow, then actually net income grows faster than revenues. And 14.6% is good. It's even faster than our sales growth. We have a down year in 2019, and also in 2013. If you look at 2013, I'm not sure. I think you didn't get 2013, but I've looked it up, and in 2013 the net income really collapsed by 99%. But this is an exception. But yeah, we have besides that, we have a down year in 2019. So the net income is a little bit more bumpy. It fluctuates more than sales, which is very, very common. Yeah, normally net income fluctuates more than sales, than the top line growth. Okay, what about the net profit margin? Maybe could someone else maybe answer this question? Or what about the profit margin, maybe? What about Chen or Zoe Chen or Sue? Could you tell me something about the profit margin? How big is it? And what about the development? Sue, are you there, Sue? No? Okay. What about the others? Can somebody tell me? Nobody there? Okay, yeah, it's not bad. If you compare it to Apple, is it better than Apple or worse? Can you remember what was Apple's net profit margin? Yeah, Apple is better than Starbucks. That's correct. I think in the case of Apple, it was about 20%. Yeah. Yeah. What about the operating cash flow? What is operating cash flow? What is meant by operating cash flow? Okay. Okay, the average is 16.3%. And what is operating cash flow? What is meant by operating cash flow? Yeah, and what is operating activities? Yeah, exactly. Selling coffee. Very good. And then the next line, we have the capital expenditures. What do you remember? What is meant by capital expenditures? What is a capital expenditure? Okay, yeah. When you buy a machinery, when you buy a property, plant, and equipment. Then the next line is I call free cash flow, which is the operating cash flow minus capital expenditures, minus capex. So this is what is left. This is what is left for distributing the cash to the stakeholders, to the shareholders and to the bondholders. So, for example, out of the free cash flow, a company can pay dividends or can buy back shares. Do you remember? Does the firm pay dividends? Or if you do not remember, we can have a look. So where do we see our dividends? Yeah, in the cash flow statement, and there it says cash dividends paid. And if you look at this this number, is it a large amount or is it a small amount? Compared with what is it compared with buybacks? Where do you see buybacks? And okay, so here we have the cash dividends and the repurchases, and if you the buybacks. If you compare those two, which is larger? Buybacks is larger. Yeah. So buybacks is larger. It is really large. This is in the last year, in 2019. This was, for example, this was $10 billion US. Yeah, this is a very large number. Dividends was 1.7 billion. Yeah. So for example, to take that into perspective, we can look at the net income and have a look what is net income in an average year. So we see here this is net income, or as they call it, net earnings, which is the same. So the net earnings is about 3 to 4.5 billion, and we had 1.7 billion in dividends. Yeah, so you can say about 40% net income is dividends, but we had share repurchase and share buybacks. Yeah, so this is really huge. Yeah. Yeah, so total revenues, and you see that some of the revenues, they come from company operate store. So that means that some of the stores by themselves. Yeah, they were stores by. So licensed stores means that they have partners who run the stores. So in some of the countries, they do not run. Starbucks doesn't run the stores by themselves. Yeah, but rather they have partners who run the stores. Yeah, and then we have other revenues, and this is. Do you have an idea what this could be? Other revenue. Okay. Yeah. Ray, what did you want to say?
No, I think the revenue maybe the coffee and the service.
Yeah, it is coffee, but this is the coffee in the supermarket. Yeah, in the supermarket. Yeah. So very good. Yeah. So what about cost of sales? What is meant by cost of sales or cost of goods sold?
The revenue of the seller. Sales, and the cost of they transport the coffee.
Okay, when is it? It's the cost directly related to the products. What is this in the case of coffee? Is this for example the salary for the CEO, or is this no? Okay, yeah, very good. What is it? Is it the coffee beans they use in the coffee?
Yeah. Yes.
Yeah. Exactly, yeah. So this is meant by cost of sales. It's the cost directly related. Very good, Ray. Which is the coffee beans. Then we have store operating expenses. What is this, for example? Store operating expenses. What could this be? Think about a Starbucks store.
Utility expenses in the stores.
Exactly, yeah. For example, or the salary for the staff working in the store, yeah. So what else do we have? We have other operating expenses, which is kind of like a very small amount. Then we have depreciation and amortization expenses. Then can you remember what is depreciation and amortization? What is it? What is meant by depreciation, for example? What is
the machine? The coffee machine.
Okay, a machine, the loss in value of a machine. So a machine is depreciated, it is written off over the lifespan. Yeah, this is depreciation and amortization. So it could also be depreciation for a building. Depreciation is the loss in value over time of any fixed asset. So, and then we have amortization expense. What is amortization? Do you remember that? What was amortization again? Amortization is the same as depreciation, but this is for intangible assets. Yeah, not for fixed assets, but for intangible assets. Can you remember what intangible assets are?
Ew.
Okay, yeah, patent, for example. Yeah,
Trademark.
anything. Trademark, yeah, anything you cannot touch. Yeah. So Starbucks might have patents on certain things, yeah, and they are amortized. They are not depreciated, but if they lose value over time, then they are amortized. Very, very, very good. Yeah, good. And then we have general and administrative expenses. Do you have an idea what that would be?
The salary of the CEO.
Exactly. That is the salary of the CEO. Yeah. That is, for example, the salary of the CEO and other headquarter expenses, headquarter related expenses, something like that. Then we have restructuring and impairments. Restructuring means if a company restructures itself. So if it makes something something different in the future because it has made mistakes or something like that, that's a restructuring. And impairment, do you remember what that was? An impairment? Impairment is loss in value. This is shown here. And then we have interest income and interest expense. Yeah. What is meant by interest expense? What is an interest expense? Why do firms have to pay interest expense? Exactly. Yeah. So if the company borrows money, yeah, if they have debt, and they have a lot of debt, which is increasing, yeah, increasing over time, as we have seen, yeah. And when debt is increasing over time, interest expense is also increasing, increasing over time, yeah. So this is interest expense, yeah. And then we have earnings before income taxes. Earnings before income taxes here. Earnings before income taxes. And then we have the income tax expense. Yeah, so tax expense is you have to pay taxes. And as you see here, the tax expense is about very broadly about 20% here for Starbucks. 20% of the earnings before income taxes is the income tax expense, and then we have net earnings attributable to Starbucks. Yeah, they have non-controlling interest, but it is a very minor amount, very small. So it's not really relevant here. So we have and then the net income. Yeah, and then we have earnings per share. Yeah, we have the earnings per share. Can you remember how earnings per share is calculated? Exactly. Yeah, exactly. And as you see here, we have the average number of outstanding shares for any of those years. Yeah. So, and if you divide the net income, or as they call it, net earnings, if you divide them by the weighted average numbers of shares, you come to the earnings per share. Very good. Yeah, very good. You come to the earnings per share. As you see here, the weighted average shares outstanding over time, they go down. Yeah, in 2017, they were 1.4 million. Then in 2018, they were 1.39 million. And then in 2019, they were 1.2 million, the shares outstanding, the number of shares outstanding. Can you tell me why they decreased? Why they went down? Exactly. Yeah. Because they have bought back because they have bought back the shares. Yeah. So this is the balance sheet. This is the balance sheet, and so if you look at the balance sheet, what are the main positions here in the case of Starbucks? What is the biggest position on the asset side? So the biggest position here is, as I see it, is property, plant and equipment. Yeah, and in the case of Starbucks, what is property, plant and equipment? What is meant by property, plant and equipment? Okay, it could be coffee machines. And it could also be some buildings. Yeah, maybe they own some building. Every fixed long-term assets. Yeah, it could also be some furniture or machines or something like that. Yeah. So what else do we have? What are the bigger position? We have goodwill. Yeah, we have goodwill. What is goodwill?
Repetition.
Yeah, very good. So it's a repetition. Yeah, it's a repetition, and Starbucks is allowed to activate goodwill if they have acquired some other companies, and if they have paid more than the net assets of the acquired company, and the remainder is goodwill, and they are allowed to put that goodwill, as you said, which is kind of like reputation, on the balance sheet. Yeah, very good, a very good, Ray. Okay, then we have here inventories. What is meant by inventories? What is inventories?
The coffee beans.
Very good. Yeah. So this is what does Starbucks do? They sell coffee, and what do they need as an inventory? It's coffee beans. It's coffee beans. Beans. This is definitely inventories. What do we have here? Account receivable. What is an account receivable?
Maybe they give the coffee beans to the supermarket and they don't receive money.
Yeah, they will receive the money, but they have received it, yes, for some things. Yeah, it might be related to the supermarket, or it might be related to other things. Yeah, if you want to know it more in more detail, you have to look at the notes. But generally, an account receivable is when you have not received the money, and you will receive the money in the future. This is correct. And then they have cash and cash equivalents and short-term investments. Yeah, if you compare that to Apple, for example, what Apple had a lot was these what did they call them? Did they call them marketable securities? I think they called them marketable securities, and this was very much. Yeah, so they had a lot of very liquid, very safe investments, which is which is kind of which is very similar to cash. This is not the case for Starbucks. Yeah, Starbucks does not have so many marketable securities. Yeah. Here they have prepaid expenses and other current assets. What is a prepaid expense? And why is it an asset? Do you remember that?
Maybe they rent a warehouse. They pay the money.
Yeah, maybe they rent a warehouse, and maybe they have paid the money up front. Yeah, maybe they have paid the money up front. And why is it an asset? Why does it make sense that it is an asset? Because it's shown under current assets.
Yeah.
It is an asset because I would explain it this way. It is an asset because when they have paid up front, they have the right to use that warehouse. Yeah, and the right to use that warehouse is an asset. Yeah, the right to use that warehouse is an asset. Okay. Yeah. So maybe let's look at the liability side of the balance sheet here. Yeah. Or do you have a question to the asset side? Do you have something which is not clear, or do you want to know something?
No.
So far, so good. I think Ray had a question. Why they often buy? You wrote, Ray. You wrote why do they buy? Why they buy back so much? Okay, why they often buy back? That's a good question, actually. The question you wrote in the chat. Probably because they think that their stock is undervalued. Yeah, that might be the main reason why they do so much buybacks, and maybe also because they think, okay, they can use that for buybacks. They can borrow money because currently the interest rates are so low. Yeah. Because Starbucks probably thinks the interest rates are so low, and that's why we can use the borrowed funds, the borrowed money, to make buybacks. Yeah, does that make sense, Ray?
Yes. Thank you.
Okay, then let's look at the liability side of the balance sheet. Yeah, so this is the asset side. Here it says assets, assets, and here we have liabilities and shareholders' equity. Yeah, so and it says in the case of Starbucks, it says deficit, because actually, if you look at shareholders' equity, what do you see? What do you see here? If you look at the total equity. Yeah, it is net. It went negative in 2019. Yeah, it went negative in 2019. And do you remember what was the reason why it went negative? Okay. Okay. So the reason here is buybacks again. Yeah, because if you buy back your own shares, yeah, you have an account which is called treasury shares, and treasury shares is a contra account which reduces your equity. Yeah, which makes your equity smaller. And if it gets smaller and smaller and smaller, at some point it becomes negative. And because Starbucks has done so much buybacks, they have a negative equity. Yeah, does it make sense? Yeah. So treasury shares, which are the shares that the company has bought back, yeah, is a contra account to equity. That means it's a negative account. It has a minus sign. And when the company does enough buybacks, many buybacks, at one point in time, the total equity becomes negative. And that is what happened to Starbucks, actually. Yeah, so they have a negative equity. Yeah. If you look at the liabilities, if you look at let's say long-term debt, yeah. Well, first of all, what is long-term debt? Can you explain what is long-term debt? Okay, yeah. So it's debt. It's the money the company has borrowed for more than 1 year. Yeah, maybe at a bank, maybe they have issued bonds. And if you look at the long-term debt, you can also look at my Excel sheet. Here you see it. If you look at the long-term debt, what do you see? What happened to the long-term debt over the last 4 years from 2016 to 2019? Yeah, it went up. It went up quite dramatically. Yeah, so it went up quite dramatically. It went up by more than 3 times. Yeah, more than 3 times. And do you remember why it went up? What did they use? What did they do with most of the money? Did they need it to buy coffee? Property, plant, and equipment. Okay, some of the money they used to buy a property, plant, and equipment, but most of the money was used for buybacks. Yeah, buybacks. Most of the money was used for buybacks. That's cool. That's right. Yeah. What else do we have here? What else do we have here? So we have the long-term debt, which went up. We have deferred revenue. Deferred revenue. What is deferred revenue? It's the opposite of prepaid expenses. Yeah, this is money paid upfront, but not by Starbucks to someone else, but by the customers of Starbucks to Starbucks. So Starbucks received the money upfront. Yeah. Do you know what a Starbucks card is? Yeah. So a customer walks into a store, buys a Starbucks card. The company gets the money, yeah, but has not provided a service or provided a service, sold the coffee, but the company has already gotten the money, yeah, and this is deferred revenue. And why is it deferred revenue? Because it is a liability, because the company has the obligation, yeah, to provide the coffee, yeah. And when the company has provided the coffee, has sold the coffee, then the deferred revenue is, the liability is reduced. Okay, does that make sense? Yeah, this is deferred revenue. What else do we have? Other long-term liabilities. Accounts payable. What is accounts payable?
They took the coffee bean and they not paying the money.
Okay, yeah, they buy the coffee bean, but they have not paid the money. Yeah, they have not paid the money. This is account payable. It's kind of like the opposite to
account receivable.
Genau, exactly. It's the opposite to accounts receivable. And then we have income taxes payable. Yeah, these are income taxes that the company has to pay, but the company has not yet paid. Yeah, that the company has not yet paid. Yeah. Okay. I would say let's have a break here. And let's meet again in 10 minutes. Yeah.
Okay.